Hello, this is Brian Shannon from AlphaTrends.net. It's Wednesday, the 25th of June, 2008, and we had the Federal Reserve meet today. They left monetary policy alone, but we had big volatility in the market. S&P 500, the spiders finished with a gain of 85 cents, or about 2/3%. When we look at the daily action, that is just today's action on this 1-minute time frame in the black moving average in there, the VWAP, we see that the buyers took control early on and then pretty quiet going into the Federal Reserve meeting. Then at 2:15 Eastern, that's when we saw the real volatility as this market really gyrated a few times real hard. Then it looked as though the buyers had taken control, pushed it up to 133.40, and that move failed to hold at the end of the day. The average price this spider traded at today was about 132.50. And this is again the reason why I was warning yesterday that that these types of days are really not good days for trend traders. They're more it brings out a lot of emotional movement in here, and it's really easy to make mistakes and get punished severely for them when things are moving as rapidly as they are, like we saw in the S&P 500. So to make sense of today, we have to back it up a little bit and take a look at it in a larger term time frame context. What we were seeing yesterday was the possibility of a higher low developing in here, and with this morning's strength, that higher low was matched with a higher high. And here we found that initial resistance along the declining 5-day moving average, popped up above there, and I said that if we get a rally, that I wouldn't expect it to get much beyond about 133.5 as a first level, and if it were to get up to that, then it would the next level of potential resistance would be found at 135. Well, 133.50 was about all it could muster here today as it got up to that prior level of support, and we'll back it up to a 30-minute time frame to get a little bit better look at that level. So this market is just really stair-stepping lower. You see this real nice pattern of lower highs and lower lows, and I don't mean nice as I'm taking a judgment of whether I prefer to be bullish or bearish. I'm looking at it from a textbook standpoint. It just makes these nice pattern of lower highs and lower lows. It rallies up to that prior level of support and then finds resistance and gets hit again. So now we have to look at this and say that the important levels for this market right now are if it can get back above 133.5, then perhaps we're going to see a little bit more consolidation through time. If, however, we see that this low right here, near 131, is taken out on the downside, then I think we're going to have a further deterioration in the S&P 500, and then we'll be looking at that 130 level once again, which was briefly tagged earlier in the week, and we've got a possibility that perhaps the market unwinds from there. So right now, realistically, I think you've got to look at this market and say we need to see this volatility settle down for a day or two, and a lot of times that's what it takes after a Federal Reserve meeting, that we get these wild gyrations for a couple of days as people try to make sense of where they think the market's going to be and position themselves for that based on their views of the economy 3 to 6 months down the road. And right now, those bets really kind of haven't been made, and it's anyone's market to take control of here. However, with the weekly and the daily time frame, weekly right here, and the daily time frame looking as bearish as they are with declining 10, 20, 50, and 200-day moving average, you've still got to be very careful and give the benefit of the doubt to sellers. The Russell 2000 finished with a gain of 80 cents, but even, just eyeballing this daily time frame, you can see it's still below this level right here where we have the neckline of that head and shoulders pattern. Near about 71.60 has been the level we've been really monitoring. Here on an hourly time frame, you can see that as well. We've got that declining 5-day moving average. Generally give the benefit of the doubt to the sellers when we see a declining 5-day moving average. And again, this is the key level here. 72, 72 and a quarter, getting above and holding above there. Then maybe this market can recover a little bit. But it looks like the handwriting is still on the wall for a deeper decline, at least down to that $70 level. And on the 10-minute time frame, we can see here just kind of a neutral sideways activity. Same thing, give it a couple days to settle down after the Federal Reserve meeting, but be very careful because we're at this prior level of support, and I would say, up to 72 and a quarter or so. And we need that 5-day moving average to flatten out if this market has the possibility of turning back higher. So, odds favor, in my opinion, further deterioration here. This larger level of support is broken, tends to act as resistance. So continue to be very careful. If the market somehow manages to rally above 72.25 and hold up there, then I would be quick to cover any short positions I had outstanding, though. The oil USO, same thing in here, just still kind of neutral. It had a big sell-off intraday, but realistically, it still remains in this range of 106.5 up to 113. If you look at that 1 minute time frame, you can see it really spooked some people on the long side for some reason. But buyers were able to regain control in the USO here, and now it's back. It closed back above the average daily price. So, is it sucking in more shorts before this market breaks out, or are we risking the possibility of a breakdown? Right now, it's too early to say. The path of least resistance on the longer time frames remains higher, so you have to be careful if you are looking to pick a top. It's the most expensive job there is on Wall Street, is picking tops. I've never met anyone who can do it with any consistency. The NASDAQ 100 was up 76 cents, closing at about 47.5. I got an email from someone today saying, are you still looking to short it up near 48? And I said, what I wanted to do, and what he was referring to was, I think, earlier in the week or last Friday, I said, if we get a more significant bounce, it might take it up towards this 48, 48.5 level where we see that 50-day moving average. That the market remains trapped below this 50-day moving average. The 10 and 20 are declining, so still want to be very careful in here. We've seen a couple days sell off, followed by big volatility. The NASDAQ held on a little bit better here though today. So in terms of the larger market groups, and RIM is supposedly reporting after the close. Let's see on a tick chart, see if we can see any action in there. For some reason, it doesn't want to populate, but okay, so here we have it. Close the regular session at 142.34, and here we are down at 127. So looks like pressure from Research in Motion, at least, may be on the NASDAQ tomorrow. This stock is trading at what price? 128 right now. Let's take a look here. That puts it down about this level, equal to about the lows before this most recent rally. So be careful still in this NASDAQ. We're probably going to get a little bit of deterioration in the NASDAQ 100. Let's see if they're trading down at all in a moment. But we've got this downtrend that's emerged with this lower low yesterday. Market was able to rally back above it today, but getting back below 47, 46.75, then I think you've got to look at a possibility of further deterioration. So we're trading at 47.24, closed the regular session at 47.57. So right now, down about 32 cents. And, we're at a very volatile area in this market. And the NASDAQ appears ready to break down. The IWM appears ready to break down. S&P 500 is busted. There's a lot of risk in this market. Hopefully you've read my book and are learning how to look at this objectively. I've also got a class on Friday with a couple spaces left. I'll put up a link on that on my blog today, and talk to you tomorrow.